Today, folks, we're going to talk about this one Canadian dividend ETF that has crushed the performance of the S&P 500 this year. And if you zoom out on the long scale since inception, has absolutely crushed the Canadian markets. I mean, comparably, VCE represents the broader Canadian stocks, and it has literally doubled the performance almost. And we're talking about the BMO Low Volatility Canadian Equity ETF. And I'm going to tell you right now, if you got a friend that works at BMO, if you yourself work at BMO, say, hey, Kyle talks so positively about our ETFs, maybe we should sponsor his channel. I would greatly appreciate it because no, this isn't a sponsored video. No, I don't own this ETF, and I have talked about it in the past, and many of you wanted an update. So if you're on a path to financial independence, if you damn well one day want to retire early, go hit that subscribe button if you enjoy these breakdowns. But I want to answer some of your Q&As over the week before we talk about this ETF, because if you're a Canadian investing, these might be things that concern you or questions that you might find relevant. But first and foremost, I prefer to trade in Canadian funds, and I see the TSX has GOOG, which is Google, and most of the other tech names, but their share prices are really low compared to what I see on the NASDAQ. Are these holding companies? Do you know how they work and if there are any risks involved trading these lower priced Canadian funds versus the US funds on the NASDAQ? Now, personally, I believe over periods of time, you should get enough capital together to actually just own the actual stock, because this is a way to get involved in being in the investor class. If you're new to investing, you don't have a lot of capital, this is a great way to get started. And they're called CDRs, and they were first introduced by CIBC. And what are CDRs? Canadian Depository Receipts, which basically are just fractional shares. So it's going to be like 1/10 of a full share of the company or the stock price if you were to buy it on the NASDAQ. And it's already converted to the Canadian currency for you. Now, I don't recommend these personally. I think they're a great way to get started, but if you're new to investing, I recommend first and foremost not looking at individual stocks, but more or less buying broader Canadian ETFs that represent the entire world economy. This is a great place. There's no thought involved. It gets you into the investor class. It gets the habit started to be a regular investor and to continue to cost average. And these are the path of least resistance to retirement, in my opinion. And you can look at stocks like XEQT. It's one I personally own. If you want to own the S&P 500 for some more growth, you can just buy VFV. This is where I would start before doing anything else, because buying individual stocks is purely gambling. That's what I do on this channel because I mitigate it in my portfolio to try and get outsized returns. It's not something that everyone should do. It's for entertainment purposes only. And I got another question here based on just that. Hey bro, got a question. I haven't bought a stock before, but I have a good feeling that Rockstar stock is going to go crazy over the next year for the obvious reasons. We're talking about Grand Theft Auto 6, the most hyped piece of media ever produced. And I have $10,000 to invest. You think it's a good start? And absolutely, I do not think it's a good start if it's your entire portfolio. And I'm somebody that's gambling on this. I'm actually up on it right now, which I'm grateful for. But if this thing continues to run long before the game comes out, I'm not going to take the risk, because there's a lot of market risk owning individual stocks. I mean, you never know. Black swan events could happen. This stock could fall out of the sky. I mean, they could continue to delay GTA 6. We just don't know what the future holds. That's why in my total portfolio, like, I don't make individual stocks any more than 10 to 20% of my entire pie, but most people shouldn't make it any more than 5 or 10%. But again, I'm somebody that pays attention to this pretty regularly. I have no problem cutting losses or selling this if it doesn't go into my favor. I don't recommend this for most people, but if you do like it, maybe own a little piece, but really start paying attention to VFV or XEQT and maybe make that the large chunk of that $10,000 investment for your future. Now, getting into this, I really want to talk about this BMO Low Volatility Equity ETF, because for those of you guys asking me these questions about CDRs and things like Take-Two Interactive, those are very volatile investments, and a lot of people don't want volatility, because if you've never experienced a major drop like the pandemic, you don't know what it's like to see a stock drop 30 to 50%. And trust me, it's a mental game of insanity of, you know, riding through those moments. So it's important to understand that that's going to happen at some point in your investing career, and you got to have the stomach to withstand it. So a lot of people don't want that volatility, so they look for ETFs like this that remove it, so they don't get the extreme upswings and downswings, and they get more of a consistent up to the right like return. And I want to show you this stock first and foremost. Breaking it down, it does have a higher expense ratio, which I don't appreciate, and the dividend yield might not be as high as you're looking for, but for a total return investor that just wants a bit of yield and a nice steady return, this is a great ETF, because when I was looking at the actual price performance here, I'm shocked to see that this has actually had a 12.28% return since inception, and comparable to, say, VFV since inception has only returned 9.22%. So it is outpacing the broader Canadian markets by almost, what is that, like 3% annualized? I mean, that adds up substantially over a 10 or 20 year period. And you can see pretty much throughout its entire history, it's never really offered less than a 10% annualized return. So this is astonishing. It's astounding. It's great. Now, I will say this isn't a place I would go for dividend returns because I really like VDY, the Vanguard monthly paying Canadian dividend ETF. And we're going to compare that to VCE as well. And we're just going to compare the dividend growth rates. And if we look at VDY first, it's got an 8% dividend growth rate. VCE offers a growth rate of 7.36%. And this BMO ETF only offers a 5-year growth rate of about 5.18%. So not nearly as impressive, but again, if you're total return oriented, dividend growth shouldn't matter necessarily as much, but I do like that monthly income, and you can see why I flock so heavily to VDY. It's a good place to get cash flow on a monthly basis that increase over time, but I'll obviously do updates and more videos on that in another time. But first and foremost, if we take a deeper look into BMO and its holdings here, I'm very impressed because they're all stocks that I would love to own on an individual basis. So we just pull up the holdings here. We'll take a look at the top 10, and you can see these are food companies like Metro, Empire, Loblaws, the TMX Group, Thomson Router, Waste Connection, Hydro One, Fortis, Intact. In fact, I actually pulled up the entire list on a spreadsheet here because if you scroll down, there's companies we've already talked about like Dollarama are in here, Amera. What's really neat too is they even hold some of the telecom giants like TELUS and Bell, but you'll see that they only represent about 4% of the entire ETF. And you'll notice the top holdings don't make up more than 4% individually. So it's probably one of the most diversified ETFs and actually lower weighting the banks. Like Royal Bank is way down here at 1.75%. So if we take a look at the industry sectors, you can see financials are 20%, consumer staples are 18%, industrials are 14%, utilities are 13%. If we just do a quick comparable to VCE, you'll see that most of the Canadian economy is made up by financials and energy, and this is a really different ETF in comparison because you can see financials here in VCE are 40%, energy is 17.37%, technology is 11%, basic materials 10%, but you can see almost all your money is just basically in financials and energy. So BMO is actually giving you a much more diversity in the Canadian markets. You're even getting some real estate in here, which is nice, but most of it is in financials, consumer staples, and industrials, which are considered, and utilities. All of these are considered highly stable industries, and obviously no one sector makes it more than 20%. So the more I dove into this, the more fascinated I become by the returns and what a great ETF this might be for somebody in retirement, somebody that wants to balance out their Canadian exposure where they might get better returns, but lower volatility. This would be a great ETF to pair with something like VDY or XEI or VCE if you're just looking for Canadian diversity and exposure, but you don't want to give up the growth, right? So you can get a bit higher of a yield, pair it with something that you love, and it's a great ETF overall in my opinion. But yeah, I was shocked to see how well it was doing this year. If we even just do a quick comparison to say VOO, we can actually see year to date it actually has been the best performing stock. Now, over long periods of time, I will point out that the S&P 500 has absolutely crushed the Canadian markets. Tech companies, the US has been a dominant investment vehicle for me personally. And as somebody that likes to, and let's just do a quick comparable, that likes that broad-based exposure, I still think XEQT is probably one of the better investments for most people. If you look at 5 years, XEQT has actually kept up with the performance of just about all these Canadian stocks and the S&P 500, but recently the S&P has just kind of elapsed a lot of the Canadian and broader global markets. However, these are just my personal opinions, but I'd love to know what you think in that comment section below.